Okay, quick word for Applied Series subscribers before we head in. We are 2 weeks away from the start of the Portfolio Management and Construction Seminar, which is going to be about 6 months long, weekly videos every week. About 2 weeks away from the start, so you should have your paper account ready to go in the next week or so. If you have an account with IB, you automatically have a paper account. Instead of logging in under regular trading, there is a button you just click that logs you in under simulated trading, and then you have your paper account. You can use any brokerage you want. I'll be showing how to set things up and how to do trades, executing them on Interactive Brokers, but it is not an Interactive Brokers tutorial. You can use whatever platform you have. You may have different commands and different options. And when I say options, menu options available on your trading system that are different than mine, but for the most part, you should be able to know how to execute the trade on your particular platform using your paper portfolio. If you don't have a paper portfolio through your brokerage, if they don't offer that, you can track it using a spreadsheet. That can get complicated, or you can use StockTrack, and here it is here, stocktrack.com. And it does offer real-time data. There is a fee per month that you have to pay. I don't think it's much. I think it's like 30 or 35 bucks. I'm not sure. You would have to go through. I went through the site trying to find pricing, and I can't find pricing anywhere. So as you're going through and signing up, I'm sure you'll find pricing somewhere. But this will allow you any asset class anywhere in the world. So you can do currencies, you can do commodities, you can do futures, you could trade any market, any stock, any asset that is currently traded with live quotes. You can trade through StockTrack. So it is a good comprehensive system to use. Use a paper portfolio. Do not use a real portfolio for this. Do not use real money, because I am going to execute trades, and you're going to do the same thing. Trades that have a very high probability of losing money. You have to know what it feels like to lose money, and you have to be able to recognize when it's time to start risk managing that loss and try to minimize the loss, or hopefully turn it around and recover from that loss. So you don't want to use real money while you're doing this. So again, for the Applied Series subscribers, this extended series begins in 2 weeks. So make sure you have your paper portfolio lined up and ready to go. Before we begin this week, let's go through the economic data from last week. Everything from the economy, every measure came in better than expectations. There is nothing wrong with the economy. So when we think about the future direction of the Fed, there are no interest rate cuts because of the economy. There are probably some interest rate hikes ahead of us because core is still rather sticky. Core PCE still rather sticky. But I think going into the next meeting, they'll look at the strength of the economy and say, we're not hurting the economy. It doesn't need stimulus. It's good on its own. Which means this move away from the zero line is not temporary. There are a lot of people in the market that think we are out in the wilderness right now, and in time we will go back home to the zero line. But it was Greenspan who left home and went to the wilderness by lowering rates to 1%. And we've been in the wilderness ever since. We are now just going home. It's not as if we have left home and are in the wilderness and will go home. We have been in the wilderness for almost 20 years. We are going home. There is no reason for rates to be lowered. Even if inflation goes away, there is no reason for rates to go down. So the expectation of higher for longer isn't really setting into the bond market just yet. The equity market. But let's look at what we had in the U.S. Dallas Fed manufacturing. Yes, it's negative, but the expectation was negative 26. Came in better than expectations. The final look at building permits for May, 5.6%. Previous was negative 1.4, 5.6%. The forecast was for 1,491,000. It's 1,496,000. Canada, we'll just take a little detour here. Core inflation came in lower than expectations. So that may allow the Bank of Canada to be on pause for a while. Durable goods knocked it out of the park, 1.7. Takeout transportation, still 0.6% increase versus what we expected here, negative 0.1%. House pricing index climbed 0.7%. Housing, as we know, is on fire. Case-Shiller home price index month over month up 1.7%. Consumer confidence 109.7. Forecast was at 104. New home sales 12.2% increase month over month. Richmond Fed came in better than expected, negative 7 instead of negative 10. The shipments index negative 5 versus the previous read of negative 13. The services index negative 3. The forecast was 7. So we can point to this. Dallas Fed Services Index, negative 8.2, previous negative 17.3. So that is an improvement there. Mortgage applications up 3%. The goods trade balance came in lower than expectation, lower than the previous number that was revised, negative 91. Let's keep going here. What have we got? GDP growth. This was huge, 2%. For a final look, usually you get an advanced, a follow-on number, and a final number. The final number usually doesn't have a lot of changes from the second look. This was a huge change, which kind of suggests that there's some kind of anomaly in the statistics. It just is way too much of an anomaly to be just a better measurement system. There is something wrong with the statistical methods they're using, that the pandemic has changed the nature of the data, and they haven't really changed the nature of the models. Continuing jobless claims came in lower than expectation. The core prices, the GDP deflator, came in lower than expectations as well. Initial jobless claims came in lower than expected. Corporate profits, negative 5.9, but we were expecting negative 6.8. Pending home sales year over year, we would expect that, and month over month. Hard to read much into pending home sales. This is a home that is in some process of being sold. So if you simply have an increase in the number of cash offers with 1 week closing periods, you would show a drop in pending home sales because that home sold and is not in some process of selling. So it's hard to tear that one apart. Core PCE 4.6. The forecast was for 4.7. Still hanging in there. If you look at month over month for core, 0.3. And actually, if you take the second decimal place, which I really wish they would report, if you take the second decimal place and forecast out the 1 month annualized, you get the 3.8. Still coming down, lower than the 0.4 previous, but on forecast. Personal incomes came in higher than expected. Personal spending came in lower, which says to me that when we look at GDP at 2%, most of that came from an increase in the consumer section. Well, they actually spent more. Doesn't kind of match up very well. That retail sales has been showing that no, it doesn't seem to be there. So that's why I say that there must be some anomaly in the statistics reporting that, but still 2%. Fed's going to see that and say, well, what stimulus do you need? What stimulus do you need? You're doing just fine. What else have we got? So there's core PC. Michigan consumer sentiment. 64.4 versus 63.9 came in better than expectation. The 5-year inflation expectation came in lower than the previous read, 3%. Expectations for June, 61.5. Current conditions, 69, better than forecast. Inflation expectation final, 3.3. Previous was 4.2. It is hard to find fault in the economic data from last week if we take the economic data at its word, if we don't question the statistical models being used and suggest that perhaps because of all of these, especially a big anomaly like the adjustment to Q1 GDP from the second to the third look, usually you get small little moves. To have it that outsized and to have GDI, which is gross domestic income, be on the opposite side of the zero line than GDP, again, those anomalies, right? But the economic data, if the Fed is taking the economic data, is saying no rate cuts needed. No rate cuts needed. And PCE is saying no rate cuts needed here. No rate cuts yet. Maybe not 2 more rate hikes, but certainly no rate cuts. So I think that we can start to agree that the neutral rate, based on where we are now and what's going on, the neutral rate is either here or higher. Let's head in. Okay, over the course of the week, all yields went up, money market and capital market. If we look at the 6-month and the 1 year, on June 29th, we hit cycle highs on both of them. For capital market yields, I didn't change these to green. They should be green, but we are now up to the 7-year with yields being higher now than they were at the beginning of the year. Our curve inversion is the story. The 2 to the 10 curve inversion added another 9 basis points, now inverted 106 basis points, 361 days. So we're basically a year that we've been inverted on the curve. 106 is the deepest inversion. If we look at the 3-month to the 10-year, 162 basis points. These numbers here should be green. I don't know why my spreadsheet is not changing them green when they should be. 162. So we have 248 days here, a little over 8 months. 189 was the largest inversion on May 3rd. The reason this one is more important is that you do have a money market rate which will follow the Fed, which will follow monetary policy, and you have a 10-year rate which follows forecasts for GDP growth and inflation. So it is the difference between what the Fed is doing and what the market is anticipating the economy will do. And you have that inversion here. The forward curve becoming less inverted if we look at the 3-month in 18 months versus 3 months. This is just an expectation of monetary policy, negative 134 versus 145. The market is slowly coming to a reality that, well, maybe there won't be any rate cuts next year. So each week we're seeing so far that rate cuts are being priced out of that forward curve. The Fed balance sheet continues to run off, down another 16.4 billion. So we're down to 7.577 trillion, almost $1 trillion down from when they started balance sheet runoff earlier last year. We're almost $1 trillion down. Total balance sheet 8.34 trillion. Versus 8.362 trillion, so it's a drop of 21 billion. Being that the runoff was 16.4, there must have been another net decrease of 4.7 billion. If we look at money market flows, decreased again, 2.89 billion, but retail increased. Retail money flows into retail money market, into government increased 362 million. Into prime funds increased by 4 billion. It's institutions that had the decrease in government of 3.13 and in prime by 5.1 billion. So the question is, where is that money going? And there's a belief that, well, it must be going into the equity market. So if we look at fund flows into the equity market, we're a week off, unfortunately. So we only have numbers for June 21st. We won't get June 28th till next week. The money market fund flows happen, the data happens much quicker, but for equity funds it's a bit slower. So for the week ending June 21st, equity funds outflow of 14 billion. From domestic funds, the outflow was almost 16 billion. From commodity funds, the outflow was 409 million, and bond funds saw an inflow of 9.41 billion. This is money market. This is capital market. So it could be that money is leaving the money market funds and heading into the capital market funds. In other words, heading into the longer end of the curve to add duration in anticipation of a steepening of that yield curve. Combined mutual funds and ETFs, negative 6.28 billion. And we can look at some historical data here. Okay, so what we're looking at here are for long-term mutual funds. And this is from May 24th all the way to June 21st. If we look at total equity, you see outflows every single week while the market was going up. Domestic gives us a better picture. because it's just the US. Notice that you have outflows every single week. If we go to total bond flows, notice that you have inflows. You have an outflow here, but followed by 3 weeks of inflows. Taxable and municipal. Taxable is your sovereign bonds, your and corporate bonds. So it seems that, from May 24th to at least June 21st, the market did increase in value on funds flowing out of the equity side and flowing into the bond market. When we talk about bond funds, these are capital markets, not money markets. And over the last 2 weeks, we saw outflows from money market, but not on the retail side, more on the institutional side. But it appears that money that is in the money market funds belonged to the bond market and not the equity market. Because when we hear bullish reasons why the market is going up or will continue to go up, is there's a lot of money on the sidelines. And we're seeing funds flows out of money market funds into equities. Well, that's not playing out here as far as mutual funds are concerned. We're still seeing outflows from equities and inflows into the bond market. That the money coming out of the money market funds is more than likely going into the long end of the curve, into capital market bonds to add duration, because there's probably a belief that as the Fed raises rates higher, something somewhere significant is going to break, and which will cause the Fed to lower rates. But right now, it's not the economy. The economy doesn't need help from interest rates. It is only if something breaks. But when you hear somebody say money is flowing out of money market funds and back into equities, you can say, whoa, I don't have evidence of that. What evidence do you have that that's going on? Okay, next FOMC is this month, 24 days away. We're July 2nd, it's July 26th. We get the minutes from the last meeting in 3 days, and jobs report both for the US and Canada in 5 days. And in 4 days, we get JOLTS. Normally, we get that earlier in the week, but Tuesday is July 4th, so it is delayed. Light week on Fed speak. Wednesday, you have Williams. Thursday, you have Logan. Probabilities for July, the weighting is heavily on the 25, 86.8%, up from roughly 72%. And no rate hike was 28% last week, is now down to 13. Higher conviction on a rate increase. And given the economic data last week, and yes, even though there was some progress made on core PCE, it is still well above that 2% target. I think that the Fed has license for a rate hike. The market is expecting it, 86% probability. The economy does not need propping up. The job market does not need propping up. Durable goods orders does not need propping up. The housing market does not need propping up. And we've seen with auto sales that it was a good quarter for auto sales. The run rate is increasing. The car market does not need propping up. None of this stuff needs propping up. So I don't know that they would look at that and say, oh, we must rush and save the economy and hold or lower rates. I think they'd probably say the market's expecting it. Core is sticky. The door is open for us. We're not going to be punished if we go 25 basis points. We're not going to surprise the market. I think they'll go 25. Look at December at the 6%. Last week, 1%, little bit touching the 6%. Now it's 4.7%. This is 3 rate hikes. 2 rate hikes would bring us to 5.75. 13% is now almost 30%. And at least 1 rate hike, 47 up to 51. So at least 1 or more rate hikes have a total of 85% probability. 5.25 meaning no rate hikes for the rest of the year. 32, almost 33% has dropped to 13. And 1 rate cut. There were some holdouts last week. They're mostly gone. I expect this by next week will be gone. Effective federal funds rate still sitting at 5.07. Reverse repo peaking back over 2 trillion. But it was the end of the month. To be fair, the reverse repo was dropping all week long. On Thursday, it was 1.935, about 35 billion lower here. So it has been creeping down day after day. but it is the end of a quarter, and the reverse repo facility, the usage always increases at the end of the quarter. So you can't really judge much from June 30th, but it is back over 2 trillion, increase of almost 65 billion, and that's being paid 5.05 to be there. TGA was 366, now is 465. And our lags, and this is something that just has not really entered the conversation yet. The conversation is around how many more hikes. Is the Fed going to be on pause? When are they going to cut? The case for pausing is that these things work with long and variable lags. Just slow down and let it work its way through the system. Well, if you agree they work with long and variable lags, you have to celebrate the end of the lags, not celebrate the end of the rate hikes. And if you think, well, the lag is 9 to 12 months, that means there's 200 to 350 basis points of rate hikes that the economy has not even felt yet. So in essence, for the real economy, those rate hikes still lie ahead in the sense of their effect on the real economy. So it's not that we're at the end of the rate hiking cycle. We're somewhere in the middle of the rate hiking cycle when we're talking about the effect to be felt on the real economy. You can't make the argument for the Fed to pause because these work with long and variable lags, and then celebrate the pause by pushing up equity prices, and then forgetting that you said they work with long and variable lags, and forgetting that there are any lags, and thinking this is it, it's done. Well, no, it's not. There are still lags to be felt. Companies that had interest rate swaps in 2018 are going to see them run off in 2023, 5-year interest rate swaps, right? Those in 2019 will see them run off in 2024. So as we move forward, quarter after quarter, there'll be more companies where some parts of their interest rate swaps or their interest rate hedges have rolled off, and they will have to roll over their hedges at the higher rates. So when we think about EBIT minus I, that I factor on corporate balance sheets is going to grow at a faster rate than EBIT's going to grow, because when they roll over, they're going to be going from what was an effective interest rate of 0.08% all the way to 5.07%. Those that had interest rate swaps that were about 4 or 5 years old that are rolling over are going to be hit with almost 500 basis points higher of I after the EBIT, and that is before you get to net income. So you have to consider the lag, and the effects still need to be felt, and I've not heard that conversation in the financial press and the financial media to any significant degree yet. I do expect that will start to take more prominence as how much more has to work its way through the system, because we can't assume that while there are no lags, it all happens right away. It all happens right away for the marginal borrower, for the person who's going to show up and say, I want an interest rate swap today. Well, then they will feel it. But 30-year fixed income or fixed rate mortgages, they don't feel it. Companies with fresh interest rate swaps in place from 2019, 2020, 2021, it's going to be 2025, 2026 before they feel it. So we must accept that there are lags. We must accept it. Okay, real yields. Some excitement here. Look at the 5-year, 1.95. On June 29, they printed 1.99. That is a cycle high. So the 5-year real yield is now at a cycle high. Look at where the 7-year is, 174. It looks like it wants to take out the 178, and the 10-year at 159. 15 more basis points, it takes out the cycle high. These were the October-November highs. We just printed a new one, 1.99. The real yield from the 5 to the 10 is now inverted 36 basis points. Basically nothing going on inflation break-evens here. But this is the most damaging thing to cash flows, and while real rates were going higher, and as we've seen, while money was flowing out of equity mutual funds and flowing into bond mutual funds, real rates going higher, the market just kept marching higher. which is a discrepancy. You look at that and you think, I don't know, I can't make sense of some of the moves. Let's look at Fed Funds Futures. It has really flattened. You can't tell that it's flattened here, but it's really flattened because look, you're at 94.6 here all the way to 95.1. That is a 50 basis point difference. Earlier in the year we had almost 110 basis point difference between the lowest point and the highest point. So last week, November, bottoming out at 94.675. We're now 94.59. So the implied rate has increased by 8.5 basis points. Going out to December, 94.615. So that has increased 11 points. Look at the difference between the November and the December now, 59 to 61.5, 2.5 basis points. You remember earlier in the year, there was almost an implied 50 basis point rate cut that the market was putting in by the end of the year. Well, that's gone, and now they're going to at least one rate hike by December. That 5.38 is in the mid-range of 5.25 to 5.5, which implies one rate hike. Going out to March, 94.945 is now 94.765, implying a rate of 5.235 from 5.055, 18 basis points higher on the rate. And looking out for 2024, sort of getting the message as well, 4.18 ending 2024 versus 5.32 December 2023, 114 basis point drop. Last week was 144. We were as much as in the 150s, implying six 25 basis point rate cuts. Well, now we're down to like maybe 4.5 25 basis point rate cuts. This is using 1 month SOFR. TLT down 0.37. Had a volatile week, but overall down 0.37. Not too bad. SPY up 2.32%. And I did some activity on TLT when this happened. I felt that that's a great opportunity to get my position because I really do want these things put to me at this point. So I'm getting aggressive. I sold 200 of the August 102 puts at 209, and as it continued to drop, I had an order out for the 101 puts, but I only got 10 of them filled, and I got those at 180. So that would give me 99.20 on an assignment, and if the 200 were assigned to me, that would get me 20,000 shares at 99.91. I'm comfortable with that. 48 days to expiration. I also sold 10 puts, 126 puts on October ZB, the long bond, at 2 and 16.64, and it closed at 2 and 18.64. The pink number here is what it closed at. I sold 200 at 209, and the next day, unexpected. I didn't expect it to rally like that, but it closed at 158 for a nice gain. I haven't taken it. And the 101s I sold at 180, closed at 127, and my ZBs I'm almost flat on, just 2/64ths off on that. So I'm getting a lot more aggressive on selling puts. I haven't bought any more calls yet, but I am looking at the March 105 calls that I will put into place, but I'm going to wait for earnings season to get underway before I start thinking about that. But that is my next purchase, is the March 105 calls on TLT. I really do want these put to me. I have been selling puts on TLT for some time and just making great money on it because I do want it put to me. Isn't it odd that when you want risk, when you really try to get risk, some reason the market doesn't want to give it to you, and when you want to avoid risk, the market shows up full force at your front door with an army. You know, precisely when you don't want it. But when you do want it, the market is like, nah, you got to catch me if you can. I mean, selling puts on home builders more and more and more aggressively week after week, and I never get them. And now they're at a price where I think, now I don't want to sell puts. But here I am selling puts on TLT, trying to be as aggressive as I can, hoping to get something. And, you know, hopefully I'll get them. I would only allow them to be assigned if there was a loss in them. So in other words, if TLT was at $99 by August expiration, I would let them be assigned at 102. But if TLT was at 101.50, well, then the options only have 50 cents worth of value. I sold them for 209. Why not roll them over into September and sell the 101s and get even more money? I know I'm going to do that. Even though I want them assigned, I know I'm going to get greedy and do that. So if they're underwater by expiration, I will just let them be assigned. If they have value, I'll take the money and roll them over. Okay, mortgage rates still hovering above 6.5, sitting at 6.71 as of June 29th, week over week increase of 4 basis points. But over that same period of time, the U.S. Treasury increased by 5, so the spread decreased by 1. Mortgage REITs, agency, almost 2% up. Annaly, down 0.55. ABR, killer week. They are now in the S&P 600, so funds had to buy ABR. If their index is the S&P 600, they had to buy it to some degree. Even if they're underweighting it, you still had to buy some shares, less than the index, but you still had to add them. So 8.57% on ABR. So that short report that came out a few months ago was simply just a massive buying opportunity for anyone who really followed ABR and understood their business model. It was just a massive buying opportunity. That has done very well. IYR, this is very odd to me, up 5.23%, does not care about higher real rates, and it should, because those cash flows are very bond-like. It should have had lower present values on those, and I think what's doing this is that you're getting some deals in the private real estate, commercial real estate space, where we're seeing private buyers willing to come in and buy properties now. And if that continues, at least it puts a floor price on property value, and that might have been the boost that IYR needed, but I still remain short, but it was not a good week for my IYR position. I went from a gain to a loss. Digital Realty up almost 10% on the week, 9.33. I had sold puts on this one, and it wasn't a high conviction thing. It's just, okay, you know what? With all the AI hype, they're AI adjacent. They'll probably go along for the ride. I wasn't very aggressive in selling puts on it because I thought, I don't want to own it. I'm just really playing momentum here, so I wasn't that aggressive. But look at that. Look at the home builders again. 52-week highs printing across the sector. DHI up 1.07%. Lennar another 2.5%. Toll Brothers almost another 4%. And I believe it was Toll and Pulte that increased their dividend last week as well. KB Homes almost flat, negative 0.6. Pulte 1.85. Hovnanian up another 6.2%. The XHB is up 4.48%. This is just for the week. This is just for the week. These things are up 50, 60, 70, 80, and in Hovnanian's case, over 100% year to date. If I told you those numbers, you'd say, well, they're software stocks, they're tech stocks, right? No, they're home builders. Well, mortgage rates must be below 3% then. No, they're almost 7%. You'd have to stop and say, well, what the hell is going on? Home prices must have crashed. No, they're only down 1.7% year over year. You would have to stop and say, whoa, wait a minute here, right? ITB, this is home construction. This is home builders, home construction up 3.9%. Look what's going on here. House price index for April, month over month, up 0.7. The expectation was up 0.3. Housing prices are stronger than expectations. Case-Shiller up 1.7%. The expectation is 1.5. Year over year, after 500 basis points of increases in the federal funds rate, housing prices have only given back 1.7%. Only given back 1.7%. That's why if I told you all of these numbers down here of how much the home builders are up, you would think that something had to give somewhere. Mortgage rates must be really cheap, or housing prices must have crashed. And I said, no, mortgage rates are almost near the highest of the cycle, and housing prices are basically flat from before we started increasing rates, which were already super elevated. I have a hard time believing this, but here we are. 50, 60, 70, 80, 100% increases year to date. Unbelievable. Anyways, I have sold half my positions. I'm no longer selling puts on them, and I sold half my positions because, listen, when you are up that much in such a short period of time, it would be foolish not to take some money off the table. Now, I don't think that they're about to pull back at any time soon because the fundamentals still remain in place. As long as mortgage rates are high, existing home sales are going to be low because you have fixed rate mortgages. Why would I sell when I have a 3% fixed rate mortgage just to buy another house with no real benefit on price? It's not as if price has decreased to buy another house just to get into a mortgage at more than double the interest rate. So existing home sales just aren't on the market. So it is just a money printing business for new home sales. And we're going to look at lumber prices shortly. That's creeping up, and that's going to push the pricing of new homes up as well. And it's creeping up because, well, you can't buy an existing home. You got to buy a new home. So new home construction, as we've seen, is on fire. And you know what else is on fire? The very wood itself. Forest fires. Canada is basically on fire. Unbelievable. Yeah, so I took some money off the table only because it's been such an incredible run. There's no point in being greedy. Half my position is there, so it'll continue to work for me. But I'm not selling puts anymore because I don't want to own them at these levels in front of what I think is an equity market that has to come to terms with its discount rate, and it hasn't yet. New home sales, as we said, up 12.2%, mortgage apps up 3%, pending home sales year over year down 22.2%, month over month down 2.7%, but it's hard to read much into pending home sales. All right, let's have a look at copper. HG futures ticker. This is the December futures over the last week. The July price sitting at 3.744, the September 3.764, and the December 3.7715. Almost a flat curve in terms of the futures term structure. Slightly upward sloping, but you can call it flat. This happened, and the price fell down towards the low 370s. I said I would wait till the low 360s, but I didn't. I sold 5 in initial position of the November 335 puts with the December underlying at 915. Closed at 730 because we had this the very next day on China hopes, right? Fourth time's the charm. Remember last week I showed you the first China hope and the rally in copper, and that faded. Then the second China hope, and that faded. And the third China hope, and that faded. Well, you know what they say, right? Fourth time's the charm. I'm still very convicted with copper. Even though I don't think the China stimulus is going to amount to much, I'm still very much in on it. Average age of the top 10 mines is 9.5 years. So to get more copper, you have to dig deeper. But the deeper you dig, the lower the grade ore you get. So your yield per ton continues to drop. And output has decelerated. Output growth has decelerated in recent years. Think about that. 95 years is the average age of the top 10 mines. I am long FCX, COPX, Rio, and BHP plus puts and aggressive puts. When I'm selling puts, I'm 0.4 to 0.5 delta on all of them. I don't mind them being put to me. I want them to be put to me. I'm good with that. And I now have exposure to the futures themselves, which you can get directly with CPER. The ETF CPER plays the futures. COPX plays the miners. You can get it with CPER, but it is more efficient on a capital basis if you're selling puts to do it right directly on HG. But if you're not comfortable doing that, you could just buy or sell puts against CPER, which is an ETF that does just that. Okay, let's have a look at wheat and corn. I didn't put the chart for soybeans up, but soybeans had a killer Friday. Price straight up, 80 cents per bushel. But wheat took a beating and corn took a huge dump. You can see it happening over here. This is the December contract. You can see it finishing under 495. This is December wheat, 6.64. You had a report out on Friday which reported acreage under seed and inventories. And here's the inventory, the quarterly grain stocks for corn, soy, and wheat for June. All of them came in below the forecast. All the inventories are coming in below forecast. We're coming into the end of a cycle, so this is important. They all came in below their forecast. Corn dropped significantly, wheat dropped, but soybean increased. And it wasn't so much because of the stock that is available, but the amount of acreage under seed and the increase. So we'll look at some of those charts shortly. For wheat, I said that I would want to engineer a break-even around $6. The 680 puts I sold for 50. It's giving me a 630 break-even, but I didn't sell a full position. I sold the 680 puts for 50. For corn, I got a little bit more aggressive here. Down 15% in 1 week. Wheat was down 12%. I sold the 500, when I say 500, these are quoted in cents, right? This is not $680, this is $6.80, and this is quoted in cents as well. Ags are quoted in cents. So when you see live cattle at 180, that's $1.80 per pound. This is $5 per bushel. So I sold the $5 per bushel puts for 37 cents, break even 463. I sold the 520s for 36, break even 484. I said I would try to engineer a break even around 5. If we look at the USDA reports, they're forecasting a price, average price per bushel in the US for the 23-24 season of 480. Based on their forecast of the ending stocks, production, and use. So based on that, they're forecasting 480. So my break even is a little bit below the 480. And for the 23-24 season for wheat, they're forecasting an average U.S. price of $8 per bushel. So I got a little bit aggressive there. Now all these forecasts are based on weather. If the weather shows up and if the yields per acre show up, then you're good. So there are two factors there. Number one, your yield per acre has to come in as expected. If it comes in lower, there could be a boost to the price. And your weather has to be helpful such that the amount of crop that is in good or excellent condition begins to increase. It has been decreasing, and we saw in France their last report of the amount of fields that are in excellent to good condition actually decreased as well. And Russia and Ukraine are still a wild card. So I'm comfortable with the break even on corn being a little under 480, and I'm comfortable with my break even on wheat, thinking that if everything comes in as forecasted, they're forecasting that the fundamentals would show $8 a bushel. Let's go to AgWeb.com. Okay, so AgWeb is a farm journal. There's lots of these neat little journals, and there's some universities in the U.S. That really specialize in research about crops and farming that you can get a lot of good information from. This is their acreage report. They're just highlighting what USDA reported. This is soybean planted area. Notice that you have a decrease here in 5%. Some states you have an increase in soy planting, other states you have a decrease. The net is a decrease of 5%. That's what supported the price rise on soybean. Was just the acreage under seed had dropped, so that the production number was going to drop. And if we continue down, you'll get corn. Look at this, higher by 6%. The states where you had an increase, the states where there was no change and decrease, only a decrease in a few states, but increase pretty much across the board, so that corn production, basically based on how much is under seed right now, forecasting to be 6% higher. So even though you had corn stocks that came in lower than the expectation, production numbers running 6% higher is going to put downward pressure on price. So I don't know if they have one here for wheat. This was what I just reported to you, the quarterly grain stocks report. It's an interesting read. to go through, so I'm going to put the link, and you can go through it yourself if you're interested in that. Now this down here, this drop in corn price, if you were in the cattle hogs spread trade, that did not perform well going into Friday. That it is now in a losing position. Well, I'm underwater on it now. I added to that trade. Two things going on. Number one, corn prices are dropping, which supports beef prices. But we're going into a long weekend, a North American long weekend, which is a barbecue long weekend. So beef prices the futures prices always tend to rise into this weekend. So there is some seasonal factor going on here. But you have to think about the price discrepancy you're going to get in the supermarket. Now, when you're looking at hogs, and I'll write this out on the screen. Let's just go to the black screen for a second. And let me just eliminate some things on this screen here, if I can, just to do it on the fly. There we go. So you're looking at a hog that goes to market. A live hog is about 250 pounds, and a live cattle is about 1,400 pounds. And right now, the price difference for the live animal is about $1.06 difference, and the mean reverting difference is usually about 50 cents. That does not mean that the price of beef is $1.06 more than the price of a hog. It is the yield that you get. So once you get this pig, you have to strip down its carcass, or strip it down to what's called the hot carcass. And for pigs, it's about 70 to 75%. The rest of it is not retail meat at all. That goes away. For a cow, hot carcass is around 63%. That is hot. That means that you kill the animal, you strip it down, there you go. Then you freeze it. When you freeze it, you lose water weight. This 1,400 ends up being around 880 pounds. You're going to lose about 40 pounds in water weight when you freeze it. You know, when you unthaw your beef, you know that liquid at the bottom that looks like half water, half blood. That's what you lose. That is the weight of what you bought that is being lost. From this, then you have to start cutting, and keep in mind with the carcass, there's a lot of bone there. Your yield here is roughly about 50% when you're done on the 250 pounds, but your yield over here is around 39% when you're done. So even though you have to pay a price for 1,400 pounds, you're really only getting 39% of that retail. Now that is assuming bone in. You'll get about 550 pounds. If you cut it all up to be bone out, you get about 410 pounds. So that the difference in price by the time you get to the store, this here will be somewhere, based on pricing now, this will be somewhere around $1.50 a pound. This is wholesale at the retail level. That is just the wholesale price at the retail level. This is just the meat. This does not count the transportation to the slaughterhouse. It does not count slaughter. It does not count the transportation to the freezer, then the transportation to the butcher that then cuts it up, packages and puts it on the shelf. This is just the wholesale. Whereas this would end up being $4.61 per pound on a wholesale basis. Look at the difference here, and this is just wholesale without any transportation costs at all. So when retailers go to the store this weekend to buy their barbecue supplies, they're going to get sticker shock on the price of cattle. I normally buy the top loin, the top cut, and at Costco you get it in a long thing that looks like this, and then you cut it up yourself. Last year I was paying about $120 for this. It's $230 now. It is $49.99 per kilogram. The strip loin is about $34.99 per kilogram. That's the New York strips. Whereas pork is $7.99 per kilogram. You're going to get sticker shock. Chicken is somewhere in between here. So when you say, oh, let's have steaks this weekend, you're going to start looking at the price of these. You're going to have to go to cheaper and cheaper cuts, and even your cheaper cut can't beat pork or chicken. So the idea that you can have these kind of price discrepancies, by the time they ripple their way through to the retail level, because pork and beef are substitutes for each other. There will be substitution away. So I expect that the widening of the price gap that we saw going into the long weekend, by the time we get to the end of next weekend, will have corrected itself. All right, this is a paper that was put out by an individual from the Federal Reserve Board in June. End of an era, the coming long-run slowdown in corporate profit growth and stock returns. Let's read the abstract. For those that have the applied series, I am going to do today an analysis of this paper to explain the methodology used, the results that were found, and then, as with any paper, we critique it based on what's missing. Where do we poke holes in it? So I'll read the abstract here. I show that the decline in interest rates and corporate tax rates over the past 3 decades accounts for the majority of the period's exceptional stock market performance. Lower interest expenses and corporate tax rates mechanically explain over 40% of the real growth in corporate profits from '89 to 2019. So whenever we read something like that, right away our mind starts thinking, well, what methodology did you use? And he used a very interesting methodology using accounting identities, which are statements of fact. So you can't argue with the statements of fact. They're not statistical results, they're statements of fact, which are hard to argue with, which is a really unique approach. In addition, the decline in risk-free rates alone accounts for all of the expansion in the price-to-earnings multiple. I argue, however, that the boost to profits and valuations from ever-declining interest in corporate tax rates is unlikely to continue, indicating significantly lower profit growth and stock returns in the future. So this was an interesting read. I sort of started thinking a little bit more broadly, and I asked a question. We know that earnings can affect the multiple, but can it work in reverse? Can the multiple affect earnings? That's an interesting question. Does the multiple affect earnings? Would Q2 2023, the quarter we're going into, the as-reported earnings be lower if the multiple on the market were 17? Does a higher multiple equal lower earnings quality? Here's my argument. If the market was trading at 14 times earnings, well, then CEOs don't really have to do a lot of work to justify their stock price because it's trading at such a low multiple. You don't got to do a lot of work. But if your stock is trading at an extended multiple, what you don't want to see is your stock price tanking. So you have to make your numbers. And we all know that accounting can make the numbers, that if you can't do it with earnings, you can always do it with accounting. And last quarter, we saw the tech companies add almost $1 billion, each of them, almost $1 billion to their net income by extending the useful life of their servers from 4 years to 6 years. Well, excuse me, I thought that AI required you to massively increase the amount of server capacity that you had, and now you're saying, oh no, these are going to last another 2 years while you go into an AI buildup? Could it be that the higher multiple forces the accounting side, the CFO, to say, well, we need to justify this, and they take more and more liberties with accounting? And if that's true, we should see earnings quality deteriorate. Well, what do you think we see? S&P 500 cash flow from operations trails profits by the most on record. And this is how we judge earnings quality, is the amount of accruals. So you look at the difference between net income and cash flow from operations. Actually, you look at the difference between adjusted net income. So it's net income and you add back depreciation, and then you compare that to operating cash flow. And it has been less than operating cash flow by 14%, the largest discount since 1990. Earnings quality is at the worst that it's ever been. So the question is, if we had a lower multiple, would earnings quality be better? Would there be less reliance on financial engineering of the income statements to make your numbers? Because you don't have to justify such a high multiple of the accruals. Highest on record. This is a study done by UBS. So let's look at this top chart over here. I circle the source here, UBS. Corporate America's earnings quality worsens. Most S&P 500 firms see cash flows trail earnings by a big margin. So the black line is net income adjusted for depreciation and amortization, and the red line is cash flow from operations. Look at the gap on that, this gap right over here. So you have to go back in the record. You have large gaps over here going into the 90s. It is the largest gap going back to that point in time. This is another interesting chart over here. The number of unprofitable firms is elevated in the U.S. This is the percent of unprofitable companies in the Russell 3000. Here we are. If you look at the trend over time, it has been creeping up over time. But if you just look at the last cycle that we were at, this is 2010, 2014, you can see the upward trend. 32% of the Russell 3000 companies are unprofitable. But, in thinking about the question, I think this is an interesting research question for anyone out there that is academically inclined or that needs some kind of research project or something, some kind of idea for a paper. I think it would be interesting to look back at the earnings quality over the last, let's say, 40 years, quarter by quarter, and look at where the index was trading at in terms of its PE. And I think you would find a very high correlation between the higher the PE, well, it would be a negative correlation, sorry, the higher the PE, the lower the earnings quality. Meaning that the executives of a company are well aware of what multiple their stock is trading at and need to justify that multiple. And if as Warren Buffett says, if a company can't do it with operations, they'll do it with accounting. Is there more of this kind of accounting when multiples are elevated? We saw this in 1999 and 2000 when everything fell apart. As Warren Buffett said, when the tide recedes, we see who's been swimming naked, right? Remember all the accounting scandals at the time? All the accounting scandals, Adelphia, WorldCom, Tyco, I think it was Tyco, Enron. There was just a whole bunch of these accounting scandals that showed up. Well, are we beginning to see something like that show up now where if something happens in a couple of years, are we going to find out that there was a lot of accounting shenanigans going on just to make the numbers to justify the multiples? It's an interesting question. And when you see, in fact, that earnings quality, again, this is from UBS, right? Accruals, highest on record, and earnings quality is the lowest it's been since 1990, then yeah, something's going on to justify those multiples. Okay, why don't we have a look at lumber futures? Look at what they've been doing in the last little while here. Over the month of June, they are up 12.8%. Sad thing here on the lumber futures, there is no option volume at all. You basically have to play the price. You can't play a strike price. Wildfires and new home construction. So looking at U.S. companies, Weyerhaeuser, Ryanair, and PotlatchDeltic, I think I'm saying that right. 1 month returns 17%, 5.62, 15%. All of these, by the way, have either low volume options or no options. So they're not that exciting because you basically just have to play the stock itself or the futures itself. No real ability here for options. On the Canadian side, Canfor, West Fraser, and Interfor all up pretty much 25% because, well, we're on fire. Acadian only up about 4%, but they have a 7% dividend yield. So if you're looking for a nice little place just to hang out with very low volatility, it's got some price gain with a good dividend yield. You're getting 7% there, but still you're missing out on the big runs from the big timber producers and timber mills. But with forest fires, we're only at the beginning of July, and Canada's on fire. I mean, you haven't gone into the really scorching months yet, July, August, the dog days of summer. July, August, into the fall, that the idea that, oh, no, it's going to be just fine now, rains for the rest of the year. You haven't really even gotten into the fire season yet, and we are on fire. Some of you in the American cities might be aware that your air quality sucks. Well, you're welcome. There are times where I can go outside here and it just smells like a fire, like somebody's got their chimney going or their fireplace going, and you can smell it coming out of the chimney. It just smells like burning wood, and you can smell it. And there's now a new weather warning on my app with a big plume of black smoke. I've never seen that before, but now I have it. So we are on fire. Well, what are you burning? You're burning trees, right? And I don't think fire really cares whether it's a lot that's about to be harvested or not. The trees just burn. One more point I forgot to mention on the previous screen. Well, two more points. As you have lumber prices increase, that just increases the cost to build new homes. Second problem is all the ports on our west coast, on Canada's west coast, are now on strike. All the shipping ports. I'm not sure how much timber is shipped through waterways versus on rail and on truck. I'm not sure what the volume of that is. To assume that none of it is shipped from Canada to China, I think there is. I think raw logs get shipped, and I think in both directions. And if that's the case, well, then those prices are just going to go higher because at least for finished timber, maybe not for the raw log, but for finished timber, which is the output, that price is probably going to increase. Or if it was transported by water, then the railroads will be a natural beneficiary of that for as long as that strike continues on. Let's look at the S&P. We are 7.3% off of all-time highs on the S&P. The multiple based on operating earnings is 20 times forward earnings. If we look at the as reported number, which is the GAAP number, the forecast for that, almost at 22 times forward earnings. And I want to just list the backdrop that we're in, because I've heard this on a number of financial podcasts now. Every time the market's up by this much in the first half of the year, the market goes on to be up another X 9, 10, 11% by the end of the year. You cannot say that. You cannot say absolute statements. Everything in the market is a conditional statement. So you must go back to all of those periods of time and you must say, when the market is up this much in the first half of the year, conditioned on rates dropping, being on the other side of the recession, unemployment high and dropping, credit expanding, you must tell me what conditions they are. Because you're probably mixing up conditionals and looking at absolute statements. You cannot look at absolute statements in the market. In all of those periods when the market had a strong first half of the year, was it while interest rates were going up, credit was tightening? You have to give me the conditional. And if it was, okay, well that's the same condition we have now. But if it isn't, if it is the opposite, so let's look at our conditions that we have. And you find another point in time where we have these market conditions, and then you can say something. Rates are going up and they're going to be there for longer. They're not going lower. We're up 500 basis points year over year. And find me another point in time where you're up 500 basis points where the market outperformed in the first half of the year, and then tell me what the second half of the year was. Then tell me that. M2 is decreasing, yes, from a high level, but it will continue to decrease by another $1 trillion over the next year and is down $1 trillion since January of 2022. So the money supply is decreasing. Rates are high, they're elevated, and they'll be there for a longer period of time. Credit is tightening, not loosening, and unemployment is at a 50-year low. Margins are at historic highs. Multiples are elevated over the long-term average. Look at this, 20.03. Accruals are at historic highs, meaning earnings quality, based on what UBS said, is at 30-year lows. Give me that backdrop and tell me how the market performed in history. You cannot say, well, when the market is up, for the first 6 months, it continues on if if this conditional is rates were dropping, unemployment is high and dropping, credit is expanding, the M2 is expanding. If you have those conditionals on that backdrop, okay. But you cannot just ignore all of the conditionals, look at the absolute statement, and conclude that we're going to get that without considering the conditionals. And that's the conditionals that we have. Very different backdrop. 0% IVP for any period, 52, 26, 13. It is the lowest in over a year. And in fact, you have to go back to almost 2 years ago to get implied volatility lower. Last IVP was 10.7. Implied volatility is now lower than historical volatility by almost 4 percentage points. I have a forecast for Q2 2023 earnings. I think over 70% of companies will beat and I think you'll get record high accruals or near record high accruals. They will beat on accruals. AI mentions, I think, will be off the chart. I think the lowest number of AI mentions for even a company where AI would be a stretch, I think would be 6 on their earnings call. At least half a dozen times they'll mention AI. It would be irresponsible not to say the words AI, because it is a future that is unprovable. You cannot prove that that future will not happen. So companies that are using regression techniques to forecast sales will now call it predictive AI. They'll now call it predictive AI. And many of them will try to fit the word generative AI in there as much as they can. The AI mentions will be off the charts. And I think you're going to see an increase in payroll reduction announcements. If AI has the promise to reduce costs, as we're hearing 30%, and we're hearing more and more companies saying AI is here now, not 5 years in the future, it's here now, well, you better have some announcements about how much your costs are reducing. So I think payroll reduction announcements will be heightened for Q2 because accruals can only get you so far. That if you're going to paint a better picture, what you're hoping for is that enough analysts don't look at your operating cash flow and notice that it is significantly lower than your adjusted net income, that your earnings quality is decreasing quarter after quarter. You have to get attention away from that. So you got to focus on the future. Look, hey, we're going to have payroll reductions. Yay, that's about the future. Hey, AI. Have you heard about AI? We're doing something with AI. Well, that's about a future you can't disprove. You can't disprove that they're not going to have that great future. So I think they're going to do everything they can to focus eyes on the future and eyes away from the discrepancy between operating cash flow and adjusted net income. So I think, yeah, you're going to get a bunch of beats on record high accruals, but a whole bunch of please look to the future, here's what we're doing. And since accruals can only get you so far, I do expect some more of that to begin to show up. So in conclusion, I remain short the S&P. I added to my position on Friday. I sold the September 4,400 calls for 192 with the December underlying. I also sold more S&P futures with September. For the September contract, I shorted more of those on Friday as well. I am heavily long in the mining sector and hoping to add more. I'm long GM, I'm long Ford. I'm still long some of the home builders, even though I've reduced half my position. I'm long the mortgage REITs. I have a wheat trade, a corn trade, a cattle and hog spread trade, and I am still short the Canadian against a long yen position because the yen, the US yen pair, seems to be moving into a territory where the Bank of Japan has previously intervened. So I imagine that that's still an area that they're not a big fan of. And at some point, they're going to have to abandon this yield curve control. And all you need to get a rally in the yen is a beginning of the unwinding of the carry trade with the yen strengthening. That'll cause a cascade trade of money that has to repatriate back to pay off the borrowing currency, which is the yen. So I continue to be in that trade. Also, my long duration trade, I think it's time to move into that aggressively now. And I had said before that I would want 40% of my portfolio in the long bond, 40%. So I am getting more aggressive in the puts in terms of the delta I'm using and in terms of the quantity at which I'm willing to sell puts at, because I do want to get to about a 40% position on that. And that's what I'm doing. I think the earnings season will unfold. As I said, I think that most companies are going to beat earnings, but look under the hood for every company that reports. Adjust their net income for depreciation and amortization, and look at the discrepancy between that number and operating cash flow. You want companies where the operating cash flow is higher than that number, but that has not been the case based on what UPS has been saying. So it will be an interesting earnings season. And I think that's it for this week.